Most people believe the hardest part of wealth building is money. They think the problem is capital. If they had $200,000, if they had $500,000, then they could invest. But this belief hides the real obstacle. The real obstacle is understanding systems. Because wealth rarely comes from a single action. It comes from structures that keep producing results long after the initial effort. Real estate is one of the clearest examples of this principle. But not because houses are special. Because of how the financial structure works. At first glance, buying property seems simple. You purchase a house. You rent it. You collect income. That sounds like a small business. But experienced investors see something completely different. They see a long-term capital conversion machine. A system that transforms time into equity. Quietly. Relentlessly. And the interesting part is how slowly the transformation begins. In the beginning, everything feels ordinary. A property is purchased. Tenants moved in. Rent payments arrive. Nothing looks dramatic. But something invisible has started. A balance sheet transformation. Let us walk through a simple situation. Imagine a small rental property purchased for $350,000. The investor provides a $70,000 down payment. The bank finances the remaining $280,000. Now something unusual has already happened. The investor controls a $350,000 asset. But only $70,000 came from personal capital. Most people focus on the debt here. But experienced investors focus on something else. Control of the asset. Because assets change over time. Debts shrink. Assets grow. And the gap between them becomes wealth. Now a tenant rents the property. The rent is $1,900 per month. This money flows into the property system. First, it pays expenses. Insurance. Property taxes. Maintenance. Then the remaining portion goes to the mortgage. Inside the mortgage payment, two processes are running. Interest compensates the bank. Principal reduces the loan balance. Principal reduction is easy to overlook because it happens slowly. But the effect becomes powerful over time. Each payment removes a small piece of the debt. Month after month. Year after year. Imagine 10 years passing. The loan balance has fallen from $280,000 to roughly $230,000. $50,000 of debt disappeared. The tenant funded most of that reduction. Now another process has been happening during the same period. Property appreciation. Real estate values tend to move with economic growth. Population increases. Infrastructure improves. Cities expand. Construction costs rise. All of these forces slowly push housing prices upward. Assume a modest growth rate. 3% annually. The $350,000 property becomes about $470,000 after 10 years. Now pause and observe the situation. Property value $470,000. Loan balance $230,000. Equity equals $240,000. The investor originally invested $70,000, but now controls $240,000 in equity. This is the moment many people suddenly understand the mechanism. Wealth did not come from income alone. It came from structural alignment. Time, leverage, tenant payments, market growth. Now imagine something else happening. The investor reviews the property after several years. The numbers look stable. Rent covers expenses. Equity is increasing. The system works. So the investor repeats the process. Another property. Another tenant. Another mortgage slowly shrinking. Two assets are now running. Then three. Then four. Each property operates independently. Each one reducing debt. Each one growing in value. Each one generating income. Now something interesting happens to the balance sheet. The mortgages continue shrinking, but the property values continue rising. The difference becomes massive over decades. Let us illustrate with a hypothetical scenario. An investor acquires 3 rental properties over 15 years. Each property originally cost $400,000. Total portfolio value begins around $1.2 million. Each property required an $80,000 down payment. Total personal investment equals $240,000. Now 20 years pass. Property values increase gradually. Each property might now be worth around $700,000. The portfolio value becomes $2.1 million. Meanwhile, the mortgages have been shrinking for 2 decades. Perhaps only $300,000 of debt remains across all properties. Now calculate the equity. $2.1 million in assets minus $300,000 in debt. Equity equals $1.8 million. And remember something important. Tenants funded much of the mortgage reduction. This is why long-term investors think differently about real estate. They are not simply collecting rent. They are building balance sheets. Balance sheets that expand quietly. Now there is another insight many beginners overlook. Time multiplies stability. As mortgages shrink, cash flow improves. When a loan is fully paid off, the property income changes dramatically. Imagine a property generating $2,000 monthly rent with no mortgage payment. The majority of that rent becomes income. Multiply that across several properties. The system begins producing substantial cash flow. This stage often appears decades after the first purchase. But when it arrives, the transformation becomes obvious. Assets are producing income. Debt is minimal. Equity is large. Financial flexibility increases dramatically. But the entire structure began with a very simple decision. Acquire the first asset. That first step often feels uncomfortable. New investors worry about debt, about market fluctuations, about uncertainty. Yet experienced investors focus on something else entirely. The long-term architecture. Because the architecture determines the outcome. A system designed for compounding will eventually compound. And real estate happens to contain several compounding mechanisms simultaneously. Income, equity growth, debt reduction, tax advantages. Together, these forces gradually reshape financial life. Not instantly, not dramatically, but consistently. And consistency is the real secret of wealth. Because the most powerful financial transformations usually happen slowly. Then suddenly they become impossible to ignore. If this perspective helped you see real estate investing from a different angle, consider joining the channel. Because understanding financial structures is often the beginning of building one.